Andrew Strauss arrived in London, proudly showing off the little urn. They'll spend 4 days at home before flying out for the World Cup. And Belinda, I just can't understand how something so small can be so impressive.
Well, Mark, you would know about that. Thank you very much. Weather's next with Jane Riley, but first, here's George Negus.
Welcome to this video, which is a beginner's guide to maximising profits in the Forex markets. Now, in terms of that video intro, I just did that as a little bit of fun, but there is a serious message there in terms of trading. Small is not impressive in the Forex markets. And I actually did see someone on a forum the other day saying they'd made an impressive 30 pip profit in the USD JPY. Most beginners make the fatal error of either having too small a profit objective or snatching their profits early. And in terms of Forex trading, with volatility in the markets today, you're probably going to need stop loss of at least 100 pips. So that means you're going to need to make 150, 200, 300 pips on the other side. And I'm going to show you a basic strategy later on, which I'm going to call the volatility time strategy, which is perfect for beginners because it will help anyone new in the markets overcome the naturally risk-averse nature we have as humans, which causes us to run losses and snatch profits too early. So the strategy will come up later on. But what I want to do before we get there is just go through a couple of biases that make us so risk-averse, and they're called sunk cost and disposition. Now, I'm just going to go through these first of all, then we're going to go to the strategy, and you'll see why the strategy is so good at helping you maximize profits and also keeping your losses small. First of all, just for a minute or so, I want to give you an experiment that was conducted. It's been conducted numerous times to do with college students and what you can learn as a Forex trader from the experiment. So I just want to show you it, and then I'll be back in a moment to discuss. Welcome back after that review of that experiment, which I find fascinating because it gives a completely different perspective on what is called sunk cost fallacy, or why traders run losses. Now, sunk cost fallacy obviously is that tendency for traders not to see an open loss as a loss. It's only a loss once it's banked. That's why they hang on to it, hope it turns around. Now, if you read what's written most frequently of why that occurs, it is obviously because the trader doesn't want to be wrong. It's his ego. But it isn't just purely down to that. I think that idea of treating a trade as a possession comes into it as well. And, when you've got an open trade in the market, for many traders, particularly beginners, it's like the college student with the coffee mug. And I think if you can remove that idea of seeing an individual trade as a possession, it makes it ever so easy to take losses. And that's very easy to overcome when we go to the strategy a little bit later on. Now, while a lot of traders do have problems running losses, I think really the major problem for traders in not winning is not being able to cover their losses with their profits. I think a lot of traders can be disciplined and put stops in. I think not being able to maximize profits is really the key reason why most beginners lose money. So why can't we maximize profits, or the majority of traders maximize profits? Well, it goes back to risk aversion within us and something that is called disposition, which I just want to discuss in a moment. But I just want to show you another experiment, a couple of quotes from a great trader called Bill Eckhart, and I'll come back, discuss why traders snatch profits too quickly and how to overcome that impulse as well. So just another minute, just reviewing another experiment, and I'll be back. Hi, welcome back after that experiment, what we can learn from it, and some quotes from Bill Eckhart. Now, you can clearly see what disposition is. It is our tendency to want a certain gain, not to try and maximize our gains. And that is a real problem for most Forex traders, not just beginners. They've got a profit in the market, the trade looks good, a little bit of a reaction against them. They take the profit in. Better to get a profit than that profit turn around into a loss. Now, of course, disposition is coming from our natural risk-averse tendencies and is also linked to sunk cost fallacy. And I'll tell you something I've seen so many times, and many people watching this video might have done it. I've actually done it myself. You've got a losing trade and a winning trade. And what happens is you think you better cut your exposure because you haven't got enough margin. Cut the winning trade out and leave the loser run. I've seen that so many times. I did it myself when I first started trading. And, it is just so frequent, and it's just really linked to our natural risk aversion. Now, what I want to do is just now move on to discussing a basic strategy to get over these biases, help us make taking losses more comfortable, and also make us more comfortable in riding profits. I just want to give you a few notes on the screen, and then I'm going to discuss them. Welcome back after those 4 key principles that underline this strategy. Now, what we're going to be doing is seeing the market as our trading opportunity. Individual trades in isolation do not matter. They are not possessions at all. We're seeing the market as a whole and looking for the best opportunity. So we're going to be prepared to shift from any open trade if we see a better trading opportunity elsewhere. Now, we're only going to be trading highly volatile price spikes. The reason for that is you're going to get a quick profit, and a good profit, if you get your market timing right. Now, it's a fact that any big price spike that's highly volatile will fade, and the reaction against the price spike will be a great profit opportunity. It will come quickly. Okay, so in terms of the actual strategy itself, it's basically a very, very aggressive strategy. Okay, but it can have very tight stop loss protection. Okay, your stop is tight, it's clearly defined behind the price spike high that you're going to be looking to go against, and you should get profits very quickly with very little in terms of pullbacks against you. Okay, because price spikes, when they do fade, they tend to fade quite dramatically. Okay, now in terms of what inspired me to do this video is a member of mine wrote to me with system rules or strategy rules for implementing this type of method. And he was saying he hadn't had much luck in trading. And he'd drawn up the rules. What did I think of them? Well, I thought they were pretty good, actually. And yeah, he wrote to me a few months later, said he completely turned his trading around. I'm just going to give you his rules now, actually. He was saying that, first of all, he was using a Bollinger Band, a volatility indicator, but skewing the standard deviation to 2.5. The standard setting is 2. He was then only looking for really volatile moves where there was a significant move outside of the Bollinger Bands. You have partial candle or whole candle, even better. He would then line up momentum. Doesn't matter what momentum indicator you use, whichever you think is the best. But what you need to have is momentum needs to be at a 3-month extreme. Okay, then what you do is you look to trade against the price spike, either targeting the mean price in the mid-Bollinger Band, which is the 20-day moving average, or a significant level of support or resistance before it, and the profit potential must be at least 200 pips. Okay, now what he would do is trade the first divergence on momentum or a candle, use a fixed 100 pip stop, and then only give the trade 2 days to move significantly in his favour. Okay, if it did, obviously he would stay with the trade. If after 2 days it didn't, and he basically had a minor loss or a minor profit or not quite the profit he wanted, just take the trade out and then look for another pair. Even when he was in a pair, he was saying that, basically if he was doing well in a pair and then suddenly a new pair came up which has got more profit potential to target, just take that pair out, shift on and move to the next one. Now, it does sound simple, doesn't it? It is simple, but I think it is a great way for beginners to trade. Why? Because your stop losses are clearly defined, they're relatively small, and your profits are going to come pretty quickly. If you've got your market timing right, your profits are going to come pretty quickly, and you're not really going to get much of a pullback against you. When a highly volatile price moves fade, they fade pretty dramatically as well. Now, it is a pretty simple strategy, but it's a very effective strategy. And I think, if you see, I can't stress it enough, just see the market as your trading opportunity. Do not treat those pairs as possessions. Okay, you need to be able to just move on, move to other opportunities quickly. And in terms of taking profits, I think you're always less likely to take a profit too soon if the pullbacks are not very much against you. I think in these sorts of moves that we've been discussing, you don't really get much of a retracement against you if you've got it right. So it's easier to hold that winning trade. So I hope you enjoyed today's video, and if you ever got any questions or queries, please feel free to email me. Thank you for watching.